All right, what's up, boys? I got a video. Welcome back to episode 8 of the Trading Academy. Today, we're going to be talking about range alignment and why it's useful and why I think it's useful and how it could help you. Let's get started. So basically, range alignment, what I'm referring to is paying attention to the range in ticks and actually measuring it and measuring it in points and measuring it in however much. Because without that, you can't measure proper risk management and stuff like that. So I'll give you an example here. So one thing that I like to use this one right here. This is called ICT KYLES and Pivots TFO. I like to use this one sometimes. Sometimes I don't use it all the time, but you can see your sessions right here. So this one is really useful. It shows you New York AM, New York lunch, New York PM, London, and Asia. So you can kind of pay attention to what price is trying to go for. It kind of helps with liquidity. It's not the only way I would recommend doing it, but this is one way that could help you maybe. But I like to think of range alignment. It acts similarly at I like to think range alignment. It acts similarly to a confluence, like almost like an entry confluence or context confluence. So it's like you're aligning it on the time frame. So look, you look on something like the daily, right? On NQ, we're pushing up. Pay attention to the liquidity that it's taking, like I taught in the previous. Okay, tap into the inversion, order block. You marked out your liquidity. Okay, so chart's gonna look something like this, maybe, potentially, depending on what confluence you use. This is just top of my head what I'm seeing. So we see the daily, and this is why I always teach that you should start on the daily or the hourly whenever you're starting your trading day. Because you want to pay attention to what price looks like it might be reaching for. It looks like price is reaching towards retracing into this inversion. Probably the 50 level or a full fill, or maybe going straight past it. You never know. But until price reaches a point that it reverses, I'll kind of show you what that looks like. So look, something like this. Anytime, like, let's say there's a big move down right here, right? From here to here. Notice that price comes back up. It's because it took something out. Price slows down and it manipulates people reversing. So what did it take out? It took out all of these very, very rapidly, especially these two right here, these three right here. And then it came down right here. What is that? It's a tap into this fair value gap right here. It's a tap. And then it will act as resistance, right? I don't like using that much, but it kind of acts like resistance. Now, I'm not saying that every single thing, because I'm sure you could find order blocks, inversions. There's an inversion right here. I'm sure you could find all kinds of things. It doesn't matter. The confluences are there so you see why price would be doing this. Price tapped this inversion, came up and manipulated on like the weekly or monthly, manipulated up and then continued to take. So because price decided that it wanted to come down and take more. So here's how you use it. Once you've identified your liquidity on the daily and stuff like that, you go to the hourly, you do everything that I taught you about liquidity. And then when you're finally at the point where you're on the 15-minute, you can pay attention to the actual range. So if I'm trading New York AM, right, and I came in and it's right here, you want to see these candles are big, but let's say you're coming down to the point of entry actually where you're on the 1 minute. This is how you utilize it. Where you're on the 1 minute is you use time frame alignment in conjunction with range alignment. So this is range alignment right here. Hold down shift or just press this button right here and literally just measure how big. So that's 334 points. You need to know how many that is. So every point on MNQ is 50 cents, and every point on, wait, no, that's $2. It's $2 every point. 50 cents a tick, and then $5 a tick on NQ, right? You need to do the math to figure that out, right? Some people, they might, whenever they're entering, they might set their entry, can set your entry, I'll show you right here. You can set your entry position to where your profit and loss, instead of saying how much you're up or down, you have it on ticks if that's important to you. Wouldn't really recommend percent because you're trading this, you're not like owning it unless you are owning it, but you're probably not on this channel if you're doing that. But yeah, you need to know how many points or ticks are in the current move and how it's important because it can help you identify. If you look at something like this, here's why I'm teaching this, because you might be super zoomed in thinking this is a huge move right here, right? And then it comes up and you're thinking this is the range, right? This is the current range. You're not thinking this is 69 points, right? That's like not even a third of what this is. You see what I'm saying? So a lot of people might think this right here is a huge move up because they're super zoomed in, but it's important to look at context. So you want to go back on something like the 5 or the 15-minute and pay attention to how sessions have been performing lately. It's like London. London was 183, which is actually half of New York AM. New York AM is usually the most volatile, as you can see. This is manipulation. This is what manipulation looks like. This is distribution. This is accumulation / consolidation. Distribution. Slight distribution, but not much. I wouldn't call it much. Just continuation, really. Manipulation, distribution here, consolidation. Asia is almost always going to be consolidation. London's hit or miss. This is consolidation / could be manipulation as well. Post London comes back. This is manipulation and consolidation. So once you identify, and I'll go over that in the next video. I'll go over the power of 3 and AMD. So don't worry about what I'm saying too much. Just worry about the range. So you want to pay attention whenever you're entering a trade, you might be like, okay, I'm gonna risk $200, but then $200 might be like right here. You know what I mean? $200 might be right here because you're not paying attention to how much these candles are. Each one, like this candle right here, 52 points in one candle. That's fucking huge compared to, if you look at Asia, the biggest candle in Asia, 40 points. The biggest one. This isn't even the biggest one. This is all one big candle. So, anyways, let's see here. Yeah, so range alignment is used to measure volatility specifically. I went over my internal and external ranges, but this is how you use range alignment. So you want to pay attention to internal and external range. So if a lot of people get tunnel vision and they look at something like this and they're, oh yeah, I want to take this high. That's internal to external. But if you look on a higher time frame, what is price doing all together, right? Price is coming way up here and taking this out. This isn't shit. This is like, you could make so much more money coming here. And I highly doubt you're going to be chasing that. Most people aren't in trades that much, that long, unless you're trading options or something, or you're holding it longer. But this right here is what you need to be paying attention to. The general gist, the general context, 5 or 15 minute, pay attention to what it's doing, right? Simplify it on the hourly or something. You see what I mean? Just one move. Or no, sorry, this was the move. It looks like it's nothing. That's my point. So like if you're on the hourly and you're a higher time frame trader, you're not paying attention to how big these are, right? That's time frame alignment. Then, so this is the hourly move that came down, right? Wait, is it? I don't know. Anyways, I think it's this or something. It doesn't matter. The point is you use time frame alignment, and then this is range alignment. So you identify your internal and external ranges. This looks like dog shit to trade, but you look at like ranges that are coming here. You look at desirable points of key levels of liquidity, right? So you notice price slowed down, came down, and then went up. And then as soon as it took this out, it went a little higher than expected. But as soon as it took this out, it retraced. It's because it took out that major liquidity. So range alignment. Yeah, and I'll go over power 3, but AMD, accumulation, manipulation, distribution. Price does one of 3 things. It's either accumulating, manipulating, or distributing. And I can go over that next video. I will. But this will help a lot with that. Once you can identify this and click like that, it works well. But this also sets really clear risk management. Really clear risk management. So you know already how much what you're going to look like. Like if you were to enter right here and your stop loss is say here, you already kind of know what you're risking because you actually have to measure it. A lot of people don't measure it. They just drag it down, but then they enter and their stop's here. They're like, fuck. And then it gets ran. You need to set it to actual levels instead of just a dollar amount. You need to set points or ticks. This can also help you identify news and the kind of range that's happening from that. Like I'm sure there was a shit ton of news this day. You can kind of see how price is reacting to the news. Who's in control? Bulls are in control right here, you know? This also helps you identify market structure for higher time frame plays. So like I said, you go on the hourly, you kind of see higher time frame what the market looks like it wants to do. It wants to take out this liquidity right here. And I called that several videos ago, how price was coming down right here. I called that it was going to come out right here before it reversed. If it wants to reverse. That's the thing. A lot of people say, oh, do you think it's going to reverse? I don't know. If price fails to take this high, let's say it comes close and then it just tanks and takes out this low, maybe this low, it's going down. And then I want to see either continuation or come back up and take this out. That's the kind of things you need to be looking for. I hate whenever people ask me, what do you think it's going to do? Anyone who answers that question, who's a trader and is telling someone who isn't a trader, I think it's just unfaithful to be able to tell them, oh, it's going to do this. You see how intraday it reacts. You can tell them what it's looking like. Like it looks like it could do this or this because of this. Not go up or down, but it could go to this level or this level if it goes up or down. You need to not mirror your bias. This also really helps you identify your new day opening gaps, new week opening gaps, and then, like I said, the session highs, lows, the higher time frame highs and lows, things like that. Session bias is another thing. So, like this right here, not much, but like this is a bullish session bias. New York lunch could come down and retrace and then be bullish on that PM, or it could continue to retrace and go up, or continue. And then lastly, this helps with tunnel vision prevention. So basically, you can't get tunnel vision because you're focused on how much the price is moving. Here's basically where I'm getting at here. If I'm super zoomed in because like I see all this happening and I'm super zoomed into this looks like a huge candle, right? Because all this was so tiny, right? This looks like a fucking huge candle. It's a big candle, but it's not that big compared to like, I don't know, something like this or even more so. you need to align your ranges with this before you just hop into the 1 minute and read the tape like that. You need to start off moving down. So I always start daily 4 hour, 1 hour, 15 minute, 5 minute, 1 minute. I don't really use 30 minute or 90 minute too much anymore, but sometimes I do. But that's really what you need to be looking for. I hope that helped a little bit, because if you're super zoomed in looking at the chart like this, it's no good. You have to pay attention, because price could just tank, and then it looks like it tanks a shit ton, but it really didn't tank that much. It just came down and manipulated, and that's where the big institutional traders are entering, and that's what you need to be paying attention to. So quit staring at the 1 minute, look at something like the 5 or the 15 minute, get your context, and only go to the 1 minute when you're ready to enter, and that's it. It's that simple. Use that. Any questions, leave it in the comments. Feel free to subscribe down below and like. Have a good day, guys. Peace.